June 24, 2021. In the middle of the night, a condominium in Surfside, Florida, suddenly collapsed, killing 98 people and exposing a terrifying truth. The safety of thousands of Florida condos was never guaranteed. 3 years later, that tragedy has erupted into a statewide market free-all. Condo sales across Florida have crashed to their lowest since 2010, with coastal owners facing $100,000 special assessments and insurance premiums that can now top $10,000 per year just to keep their homes standing. Retirees are trapped, buildings empty out, and the dream of affordable coastal living is vanishing fast. But could Florida's effort to prevent another disaster end up destroying its middle class? And why does no one seem to have a way out? At 1:22 a.m., the east wing of Champlain Towers South gave way without warning. 12 stories, crushing homes and lives in seconds. 98 people died before sunrise. The building's collapse was not a freak accident, but the end of a long, visible decline. Engineers would later confirm what some residents already feared. Severe structural damage had been documented 3 years earlier. In 2018, consultants warned the Condo Association about failing concrete on the pool deck and spreading corrosion in the garage. Repair costs were estimated between $9 and $15 million, a sum that divided owners and delayed action. Arguments over money and responsibility stretched on, while cracks widened, water seeped in, and steel rusted beneath the surface. Each year, the building grew more vulnerable. When the tower fell, it did more than destroy a single community. It shattered the illusion that Florida's beachfront condos were safe by default. The Surfside disaster exposed decades of deferred maintenance and financial shortcuts, not just in one building, but across the state. Night after night, thousands of residents in aging towers began to wonder if their homes were next. The loss at Champlain Towers South demanded answers. How could this happen? And what would it take to make sure it never happened again? Florida lawmakers moved quickly after Surfside. By mid-2022, every condominium 3 stories or higher faced a new mandate, milestone structural inspections at the 30-year mark. Or at 25 years, if the building stands within 3 miles of the coast for thousands of towers built during the 1970s and 1980s. Boom. That clock had already run out. Miami-Dade and Broward counties imposed even stricter rules requiring earlier reviews for buildings exposed to salt water and wind. Compliance deadlines landed hard December 31, 2024 for most, with some extensions into 2025 only if inspectors or records were unavailable. A structural engineer describes the process. Phase 1 starts with a visual sweep. Cracks, rust, spalling concrete. If signs of deterioration appear, Phase 2 drills deeper using core samples and load tests to judge the building's true condition. In coastal zones, the odds of passing on the first try are slim. Salt air eats its steel, water seeps into slabs, and balconies show the wear of decades. County records show that up to a quarter of older buildings required immediate follow-up investigations. Failure to comply brings fines or, in severe cases, an unsafe structure notice. Local officials have condemned buildings that missed deadlines or failed to act on critical findings. For the first time, safety is not just recommended. It is enforceable, with the law demanding that problems be found and fixed before disaster can strike again. December 31, 2024 is the line in the sand. By law, every Florida condo association with buildings 3 stories or higher must have fully funded reserves for structural repairs, roofs, and critical systems. The old system, where owners could vote each year to skip or slash reserve contributions, no longer applies. That practice is gone. Now every association must collect enough money to cover the real cost of major repairs with no exceptions. The law spells out exactly what must be covered: the foundation, exterior walls, roof, plumbing, electrical, fire safety, and elevators. Reserve studies must be completed and the required funds set aside, not just promised on paper. If a building is within 3 miles of salt water, The rules are even stricter, and the deadline is absolute. Associations that fail to comply face steep penalties and, in some cases, the threat of being declared unsafe. For many boards, this means issuing capital calls, sometimes for tens of thousands of dollars per unit, whether owners can afford it or not. The goal is to ensure that when the next critical repair is needed, the money is there. But for thousands of buildings with aging infrastructure and years of deferred maintenance, meeting the deadline is triggering a financial reckoning that few saw coming. Special assessment letters started landing in mailboxes across Florida in early 2024. Some demanded $10,000 per unit. Others reached $50,000, $100,000, or even more. In older coastal buildings, the numbers climbed higher still, up to $200,000 per owner in a handful of towers near Miami Beach and Naples. The bills covered urgent repairs, concrete restoration, new roofs, upgraded fire alarms, elevator overhauls, and, for the first time, fully funded reserves. For many, the math was impossible. Owners who paid $150,000 to $300,000 for their condos now faced assessment demands that rivaled or exceeded their original purchase price. Association board records show heated votes and packed meetings. In Fort Lauderdale, one building's minutes detail a 4-3 split over a $95,000 per unit assessment. In Naples, negotiations broke down after a proposal for a 7-year payment plan was rejected out of concern for lenders. Emails and court filings document owners slashing grocery budgets or skipping medications to scrape together payments. Others simply walked away, unable to pay or sell. For retirees on fixed incomes, the shock was immediate and devastating. "We bought our condo as a retirement dream. Now owning it is a nightmare. We're left with an assessment bill we simply cannot afford," wrote one Miami Beach owner. The assessment avalanche didn't just hit the wealthy or the reckless. It swept through middle-class buildings, longtime residents, and anyone caught in the path of new compliance. The numbers left no room for denial. Decades of deferred maintenance had come due all at once, and the bill was staggering. Insurance premiums are rewriting the rules for Florida condo owners. In 2021, a typical master policy for a 200-unit coastal building cost around $500,000 a year. By 2024, that same policy can run over $2 million, 4 times higher in just 3 years. For owners, that means an annual bill of $10,000 per unit just for insurance before a single dollar goes to HOA fees or special assessments. Some buildings have seen even sharper jumps, with insurers refusing to renew coverage after reviewing milestone inspection reports or finding incomplete reserves. Insurance analyst Carla Jimenez explains the reinsurance market is driving these increases. After back-to-back hurricane losses, global reinsurers have forced carriers to raise premiums and cut exposure, especially for older coastal towers. As a result, dozens of private insurers have pulled out of Florida's condo market, leaving associations scrambling for any coverage they can find. Many end up with Citizens, the state-backed insurer of last resort. But even those policies come with higher deductibles and limited protection. For buildings that can't secure a master policy, the consequences are immediate. Mortgage lenders won't finance new purchases or refinances without proof of coverage, freezing sales and trapping owners in place. Even cash buyers hesitate, wary of taking on a unit in an uninsurable building. The insurance crisis is now a cost that repeats every year, compounding the financial pressure from special assessments and making recovery for older condos nearly impossible. Conventional financing is drying up across Florida's aging condo towers. Between October 2023 and February 2024, Fannie Mae and Freddie Mac rewrote their lending rules, demanding proof of fully funded reserves, up-to-date milestone inspections, and no pending structural repairs or special assessments. Banks followed suit, issuing internal memos that flagged any building with open assessments or lapsed insurance as high risk for owners. This means applications are routinely denied, even for buyers with strong credit, if the association can't certify reserve compliance or if a master insurance policy is missing. Title companies now flag reserve shortfalls and inspection gaps, halting closings, and refusing to issue policies in buildings that fail new standards. The impact is immediate. A condo with a $50,000 special assessment or an expired insurance policy is effectively frozen. No buyer can get a mortgage, and cash buyers are rare. In Miami, Dade, and Broward, dozens of pending sales collapsed in January alone after lenders reviewed association budgets and inspection reports. Mortgage servicers report that by February 2024, denial rates for condo loans in non-compliant buildings had more than doubled. Even owners hoping to refinance to pay their assessment bills find the door closed. Without financing, units become illiquid assets, trapping residents who can't pay, can't refinance, and can't sell. The financial system designed to protect against another Surfside now locks thousands of owners in place, regardless of price or need. Statewide, the numbers paint a stark picture. Florida condo and townhouse sales collapsed to 94,000 in 2024, a 10.5% drop from the previous year and the lowest total since 2010. Inventory is piling up. There are now 8.2 months of supply for condos and townhomes, more than double the 4.7 months seen for single-family homes. In practical terms, sellers outnumber buyers by a wide margin. Properties linger on the market for a median of 74 days, up 27% year over year. Median condo prices have slipped to $330,000, a 5.7% drop from 2023. The decline isn't spread evenly. Coastal counties are at the center of the downturn. In Miami, Dade, Broward, Palm Beach, Collier, and Lee, sales have cratered as buyers step back from older buildings facing looming assessments and insurance woes. Only the I-4 corridor stretching from Orlando's exurbs to the villages in Ocala has bucked the trend with newer construction and fewer regulatory headaches keeping activity steady. Economist Dr. Isachana Sukakhan, Dr. Alicia Hermosio sums up the shift. It is now firmly a buyer market in Florida condos. Sellers have virtually no leverage, particularly in buildings with looming assessments. There's simply no demand. The data backs her up. In many coastal towers, price cuts of 20 to 40% still aren't enough to attract offers. With so much inventory and so little appetite to buy, the market correction is deepening. The question is no longer whether values will fall, but how far and for how long. Miami-Dade sits at the heart of the condo downturn. In 2024, sales of existing condos and townhomes dropped more than 14% from the previous year, with active listings outpacing closed deals by nearly 3 to 1. Broward County, just to the north, faces a similar reckoning. Board records show hundreds of buildings in Fort Lauderdale and Hollywood scrambling to comply with new inspection and reserve rules. In Palm Beach County, the beachside towers, lining A1A, have seen months of supply surge above 10, and price cuts as deep as 40% still leave units unsold. Collier County, home to Naples, reports the steepest price declines in 2 decades. Here, older beachfront buildings are stuck in limbo. Owners receive assessment bills topping $150,000. Yet buyers vanish even after dramatic discounts. Lee County, which includes Fort Myers and Cape Coral, is struggling as well. Dozens of Gulffront towers now carry vacancy rates above 30%, with many units sitting idle as owners refuse to pay new fees or simply walk away. In each of these coastal hotspots, the same pattern repeats: aging towers, rising costs, and a shrinking pool of buyers. Real estate agents in Miami Beach and Naples describe open houses with no visitors and listings that gather dust for months. County records confirm that more than a third of all condo sales in these areas now close at a loss, with some owners accepting offers 50% below their 2021 peak. Meanwhile, the I-4 corridor stands apart. From the exurbs of Orlando to the villages and Ocala, Newer construction and less exposure to salt water mean fewer special assessments and a steadier flow of buyers. In these inland counties, months of supply remain below 5 and sale prices hold firm. The contrast is stark. While Florida's coastline absorbs the brunt of the crisis, pockets of resilience persist farther from the water. Maria bought her Naples condo at Seagate East in 2009, expecting a quiet retirement near the water. In February 2025, the association delivered a letter demanding $120,000. Her share of the structural repairs, new roof, and reserve funding now required by law. The board's minutes show heated debate over payment plans. Some owners pleaded for a 7-year option, but lenders warned that would trigger financing problems. Maria's fixed income covered groceries and medicine, not 6-figure bills. She tried to sell, but buyers vanished once they saw the assessment. "I've started skipping meals," she wrote in an email to the board. "I don't know what else to cut." James lives in Harborview South, a 1981 tower in Fort Lauderdale. In March, the board split 4-3 over an $18 million restoration plan, $95,000 per unit. The lowest contractor bids still left some owners facing more than their condos were worth. Board records document resignations and threats of lawsuits. When insurance flagged structural hazards, the building's master policy was set to expire. By August, county officials declared 13 units uninhabitable, ordering families to leave until repairs began. James watched neighbors pack up, not knowing if they'd ever return. Elena's story unfolds at Atlantica, a 200-unit building in Miami Beach. In July, Suncoast Mutual canceled the master insurance policy after reinsurers reviewed the latest inspection. Within days, residents received 72-hour eviction notices. Elena, who paid off her mortgage years ago, faced a $92,000 assessment and no way to finance a replacement home. The elevators failed, the roof leaked, and mold crept down the hallways. "We're trapped," she told a reporter. "No one will buy, no one will lend, and all anyone talks about are lawyers and bankruptcy." 3 owners, 3 buildings, each facing a different version of the same crisis. Bills they cannot pay, homes they cannot sell, and futures no longer in their control. Across Florida's coastline, the burden of the condo crisis falls hardest on retirees. Many paid cash for their homes years ago, drawn by the promise of affordable living and ocean views. Now faced with 6-figure special assessments and insurance premiums that rival annual incomes, these owners find themselves locked in a financial trap. Most live on fixed incomes, Social Security, modest pensions, or savings that were never meant to cover emergency bills of $50,000, $100,000, or more. For some, the condo was their only major asset. Bought for $200,000 or less in the 2000s with no mortgage and the hope of aging in place. That security has vanished. The reality is stark. Selling isn't an option when buyers won't touch units burdened by massive pending assessments or uncertain repair costs. Foreclosure looms for those who can't pay, but walking away means losing everything. In buildings where owners have fled or defaulted, those left behind shoulder an even bigger share of the costs. Monthly HOA fees double or triple while basic maintenance slips. Elevators break down, roofs leak, and common areas grow shabby as reserves dry up. Residents gather in lobbies and laundry rooms, trading stories of skipped meals and canceled trips. The dream of a quiet retirement by the sea has given way to anxiety, isolation, and a sense of being forgotten. What was once a symbol of middle-class stability is now a source of daily stress, with no easy way out. Association boards across Florida now operate in a legal minefield. Every decision, how much to assess, when to collect, what to repair first, carries the risk of lawsuits from owners on one side and regulatory penalties on the other. The statutes spell out a duty. Board members must act in the best interest of the association, maintain the building's safety, and follow the new reserve laws to the letter. But with so many owners unable to pay and every option unpopular, boards are caught between financial ruin and legal exposure. Meetings often dissolve into shouting matches over assessment fairness, payment timelines, and whether repairs can be delayed. Minutes from recent board sessions in Miami Beach and Naples record threats of recall elections, resignations, and even restraining orders. Some owners allege breach of fiduciary duty, filing complaints that boards acted without proper notice or transparency. Others accuse boards of acting too slowly, pushing for emergency action to avoid condemnation. Condo Association attorney Mark Feldman describes the dilemma. If the board underassesses, they risk a lawsuit for failing to protect the building. If they overassess, they risk bankrupting owners and getting sued for financial hardship. There's no safe path. Every board is one vote away from litigation. Court dockets show a surge in filings. Owners challenging assessments, contesting election results, or seeking injunctions to halt repairs. Some buildings now spend more on legal fees than on actual maintenance. The regulatory reforms designed to enforce safety have triggered a wave of procedural gridlock, leaving boards paralyzed and buildings in limbo. Broward County's budget hearing in July 2025 opened with a warning. Property tax projections were being slashed by $37 million for the coming year. The culprit wasn't a hurricane or a recession, but the collapse of condo values along the coast. In central and eastern zip codes, Fort Lauderdale, Hollywood, Pompano Beach, taxable assessments for condominiums fell nearly 10% in a single year. Commissioners debated which capital projects to delay as the shortfall rippled through school funding, emergency services, and infrastructure maintenance. Miami-Dade's finance office reported a $24.5 million drop in anticipated collections from beachfront condos, with the sharpest losses in North Beach and Sunny Isles. Palm Beach County faced an $11.2 million gap as condo values east of US 1 tumbled. These numbers, drawn straight from county budget minutes, reveal how the crisis is no longer limited to individual owners or buildings. It now threatens the fiscal health of entire communities. We are not destroying middle-class dreams by accident. This is the consequence of decades of doing too little too late, said one Lee County commissioner during a tense debate over millage rates. School districts and city governments reliant on ad hoc revenues are now forced to reconsider staffing, public safety, and basic services. For local officials, the question is whether these losses are a temporary shock or the start of a long decline. The economic fallout from Florida's condo crisis has landed squarely on the public ledger. With no easy fix in sight across Tallahassee, hearings and workshops have filled with proposals for relief. Lawmakers and advocacy groups have floated ideas ranging from state-backed loan programs for assessed owners to targeted property tax reductions for those facing six-figure bills. Draft bills circulated in spring 2025 outlined a framework for low-interest loans designed to help retirees and moderate-income owners cover special assessments without immediate foreclosure risk. The proposed loan fund would be managed by the state's Housing Finance Corporation, with repayments structured over 20 years and eligibility based on income and assessment size. Some versions included a hardship waiver for the oldest or most vulnerable residents. Property tax relief measures appeared in budget committee discussions, suggesting temporary reductions or credits for owners and buildings under mandatory repair orders. None of these proposals have passed into law. The most ambitious plans stalled in committee, blocked by concerns over fiscal impact and questions about whether state funding should cover costs that by statute are the responsibility of private associations. As session after session ends without action, the gap between political will and practical relief remains wide. For now, owners wait, hoping that the next round of legislation will bring more than debate. The legislative logjam in Tallahassee has become a defining feature of Florida's condo crisis. Dozens of relief proposals have circulated: state-backed loan funds, expanded hardship waivers, targeted property tax credits. Each time the details break down in committee, Lobbying reports from spring 2025 reveal a steady stream of pressure from banking, insurance, and real estate groups, all wary of new mandates or public funding that could set costly precedents. Internal memos from legislative staff outline deep divisions. Some lawmakers insist the state cannot bail out private associations, while others argue that failing to act will devastate local economies. The December 31st, 2024 reserve funding deadline remains untouched, locked in by post-Surfside political will and the memory of public outrage. Behind closed doors, negotiations stall over who should pay, how relief would be structured, and whether any intervention could avoid moral hazard. The result is paralysis. Owners wait for help that never comes, while association boards are left to enforce the law without new tools or funding. Economists warn that the longer the stalemate drags on, the greater the risk of permanent damage, not just to condo owners, but to the state's housing market and tax base. For now, the hard deadline stands, and the crisis deepens with each passing month. Economists watching Florida's condo market now see two possible futures. Dr. Alicia Hermosillo, a real estate economist, describes the first path as a slow recovery. In this scenario, the market works through its backlog of distressed buildings by 2026. Owners who can pay the assessment stay and fund repairs. Those who can't are forced to sell at a loss or walk away, making room for investors or developers to redevelop prime sites. Over time, the worst buildings are either stabilized or replaced, and a new, smaller group of buyers, often wealthier, often paying cash, restores some level of demand. Prices may eventually rebound, but the era of affordable coastal condos for the middle class is over. The second path is a permanent transformation. Here, the combination of regulatory deadlines, insurance withdrawals, and financing freezes leaves thousands of units unsellable. Middle-income owners are pushed out, and entire neighborhoods of older towers face demolition or conversion to luxury housing. The tax base shrinks, public services suffer, and Florida's coastline becomes the exclusive domain of those who can absorb any cost. Dr. Hermosillo puts it simply. The question isn't if the market will adjust, but who will be left standing when it does. The horizon remains clouded. Temporary crisis or lasting upheaval, no one can say for certain. In 2024, Florida's condo and townhouse sales fell to 94,000, the lowest level since 2010, amid a 10.5% year-over-year decline in 8.2 months of supply, marking a crisis most severe in aging coastal buildings. This downturn began with the Champlain Tower South collapse in 2021, which killed 98 people and prompted sweeping new safety laws. These regulations, while aiming to prevent another tragedy, forced associations to levy assessments as high as $200,000 per unit and quadrupled insurance costs. Retirees on fixed incomes now face bills they cannot pay and units they cannot sell. While some buildings have been condemned or demolished, despite proposals, as of October 2025, no state-backed relief has been implemented, and owners remain trapped by financial and regulatory barriers. It remains unclear if this is a temporary adjustment or a lasting shift where only the wealthy can afford coastal condo living. What is certain, the push for safety has come at a steep cost, reshaping Florida's coastline and leaving thousands of middle-class residents in limbo.